lot of investors are looking at Saudi real estate right now. The world is talking about NEOM, Jeddah Tower, and other super ambitious projects. People often say that Saudi now is where Dubai used to be 15 to 20 years ago. That's not very accurate. Dubai was building the plane while flying, while Saudi is building the runway first. Because the real difference is not timing, it's how the system works. In Dubai, the market drives development. In Saudi Arabia, the system drives the market. What many investors don't understand is that even after the introduction of a freehold law in Saudi Arabia, it's still not a classic freehold. This is not a free market. It's heavily regulated by the state. There is still no financing available for foreign buyers. The secondary market is not yet formed and is practically non-existent. So investors need to understand that this is a long-term game, potentially more risky, but also with possibility of higher returns in the long term. So let's break down what are the core differences between Saudi and the UAE property markets. Let's start from the foundation, land. Historically, in Dubai, land is largely in the hands of major developers. They decide what to build, where, and how fast. In Saudi, land is a controlled resource. The state defines where development happens. The state launches large-scale projects. The state drives expansion through Vision 2030. Developers don't lead the market. The state does. Projects like NEOM, Diriyah, and New Murabba are not organic growth. They are planned development. This is where the most investors misunderstand Saudi. Historically similar to the UAE, Saudi nationals could own properties freely. But expats had limited access, usually for personal use. Foreign investors had almost no direct access unless through companies or special structures. But development was already happening. Projects were being built, units were being sold, off-plan existed, just not as a global investment product. In Dubai, off-plan is a global retail market. Anyone can buy, flip, and exit. In Saudi, it worked differently. The main structure used today are musataha, the right to build an own building on government-owned land, or usufruct, which is a long-term right to use and generate income. Full freehold ownership for international buyers is not the baseline there. It's a controlled, project-based legal structure. Saudi Arabia did introduce a freehold type law in 2026, but it's not a fully open freehold market like Dubai. Foreign ownership is only allowed in designated zones and subject to regulatory approval and conditions. So yes, ownership is now possible, but it's still controlled, zoning-based and project-based system. And in a project-based system, your ownership is not defined only by law. It's defined by the project itself, by the contract more than it's defined by law. Your right comes from the sale contract, the master plan rules, and the developer's framework. So two different properties in two different projects can give you completely different ownership conditions. Saudi didn't build a freehold market first, like Dubai did. It built a controlled system and only later opened ownership inside that system. In Dubai, ownership is simple. You get a title deed, it's standardized, and it's transferable. In Saudi, ownership can vary depending on the project. So freehold in certain zones does exist, but especially in large-scale developments, you're not just buying a standalone unit. You're buying into a master-planned system with controlled supply, with project-level rules, with centralized planning. So you're not just buying a piece of real estate, you are buying into a structure. In Dubai, the flow is straightforward. Investor, developer, handover, resale or rental, exit. In Saudi, the flow is system-driven. The state defined where capital goes. It launches projects, it attracts developers, it actively creates demand. So demand here is not purely organic like it is in Dubai. It's partially policy-driven. Yes, Dubai also started as a top-down market. The government opened freehold, launched major master plans, and attracted developers. But then something changed. The market became open and investor-driven. In Saudi Arabia, the system is still in that controlled phase. Dubai was engineered and then released, while Saudi is still being engineered. In Dubai, the secondary market is active. You can resell and exit. Liquidity is part of the strategy. In Saudi, the secondary market is still developing. There are way fewer transactions, way less liquidity. An exit is not always clear. You're not entering a trading market. Again, you are entering a developing system. Dubai is a leveraged market. Mortgages are widely available. Foreign buyers can access financing, while Saudi is still more cash-driven, especially for foreign investors. That slows down speculations and changes how capital behaves. When it comes to operation of your property, in Dubai you have a full ecosystem. Property managers, broker networks, short-term rental infrastructure, while in Saudi this ecosystem is still developing. You can rent, but often with restrictions. Property management exists, but it's not as mature. Real estate agencies exist, but they are limited. So you're more involved in the process and you're dealing with more friction. Now, how to analyze Saudi project? So if you're looking at Saudi as an investor, the approach has to change. You don't just analyze the deal, you analyze the system behind it. So here is the framework. Number one, who is driving the project? Is it state-backed or private? That defines execution risk. Second, is this in a foreign ownership zone? If zone is unclear, that's already a red flag. Third, what exactly are you buying? Is it a freehold, long-term rights, or structured ownership? Fourth, who will actually live there? Is it a real demand or policy-driven demand? Fifth, when does infrastructure arrive? Because in Saudi, like anywhere else, I guess, value often depends on future infrastructure. Number six, who will buy this from you? If exit is unclear, it's not an investment, it's a bet. So analyze the liquidity. Are there actual transactions or just projections? Then you need to look at the payments. How are they structured? Escrow, developer risks, etc. Look if financing is available or it's a fully cash entry. Then think if the rules can be changed, because you're investing inside a system that is still evolving. So if in Dubai you analyze the deal itself, in Saudi you analyze the system behind the deal. In Dubai, risks are market-driven. There are property cycles, oversupply risk, price and tourism flow volatility, while in Saudi risks are structure-driven. Regulation, liquidity, execution. To summarize, Dubai is easier to enter and easier to exit. Saudi is harder to enter and harder to exit. But despite that, it might give you a better long-term benefit. And that changes how you invest. So ask yourself, would you rather invest in a liquid market or in a controlled system that is still being built? In the next video, we will speak about one of the most ambitious projects of Saudi Arabia everyone is talking about, NEOM, and why a big ambition doesn't always meet the reality. Subscribe and press the bell button not to miss the notification about a new video in the channel, and see you soon.